The Upside Tasuki Gap is identified during a market's uptrend when there is a noticeable gap between two consecutive green or upward moving candles followed by a third candle that opens within the body of the second candle and closes within the gap between the first and second candles. This pattern signifies that the uptrend continues since buyers maintain control, but a short pause allows prices to stabilize before progressing further. Concluding, charting the course with the Upside Tasuki Gap involves recognizing this pattern as a bullish continuation signal. It suggests that even though there's a slight hesitation in the buying momentum, the overall market sentiment remains positive, leading to the expectation that the upward trend will persist. Investors and traders might consider this an opportune moment to engage or maintain their positions, anticipating further gains. This pattern, like all technical analysis tools, is most effective when used in conjunction with other indicators to confirm the market's direction and momentum. Understanding its implications allows for more informed decision-making in navigating the complexities of the financial markets. The Downside Tasuki Gap is a continuation pattern observed within a downtrend in the financial markets. This pattern is identified by three crucial candlesticks that appear on a price chart during a downward trend. The first candlestick is a large black or red one, indicating a strong selling day. The next day opens lower, creating a gap, and forms another black or red candlestick, reinforcing the bearish sentiment. On the third day, the price opens within the body of the second candlestick, but closes within the gap between the first two candlesticks, typically as a smaller white or green candlestick. This does not completely fill the gap, hence creating the Tasuki Gap. The formation of this pattern signals that the sell-off is momentarily pausing, but it does not necessarily imply a reversal of the trend. Instead, it indicates that bears are still in control and the downtrend is likely to continue. Investors and traders may view the appearance of a downside Tasuki Gap as an opportunity to join or remain in the bearish trend, expecting further depreciation in the price of the asset. Understanding this pattern is useful for those analyzing price movements and seeking to forecast future market directions based on observed candlestick patterns. By recognizing these formations early, investors and traders might make more informed decisions regarding entry and exit points within the markets, attempting to capitalize on the continuation of the existing trend. The Downside Tasuki Gap is a pattern observed in technical analysis that indicates the continuation of a downtrend in the market. Identifying this pattern involves looking for specific characteristics in the price charts. Firstly, the pattern begins with a long-bodied candlestick in a downward trend, representing a strong day of selling. Following this, a gap down occurs where the next day's price opens lower than the previous day's close, and is also represented by a long-bodied candlestick moving in the same downward direction. The crucial part of the pattern is the third candlestick, which moves back up, partially filling the gap created by the previous day, but crucially, it does not close the gap entirely. This third candlestick should not extend above the closing price of the first candlestick in the series. To visualize it, imagine watching a sliding slope where the gap represents a sudden drop deeper into the slope. The attempt to climb back up this slope does not fully succeed, signaling that the momentum downward is strong and likely to continue. Understanding and identifying the Downside Tasuki Gap gives traders insights into market sentiment and helps in making informed decisions about potential selling opportunities, emphasizing the importance of recognizing patterns and their implications in the market. The downside Tasuki Gap is a pattern observed in technical analysis, indicating the continuation of a current downtrend in the market. To understand this concept, imagine the stock market as a vast ocean where the waves represent the highs and lows of stock prices. In this scenario, the downside Tasuki Gap is like a swift current pulling the waves down further, signaling that the prices are likely to continue falling. Deciphering market sentiment using this pattern involves observing three key price bars or candlesticks on a chart. The first two candlesticks move in the direction of the trend, i.e., they are bearish and downward, creating a gap between them. This gap is crucial as it represents a sudden drop in price, showing the seller's eagerness to sell. The third candlestick, however, opens within the body of the second one and closes in the gap between the first two candlesticks, but does not fully close the gap. This indicates that although there is an attempt to reverse the trend, the buying pressure is not enough to overcome the bearish sentiment, suggesting the downtrend is likely to continue. Understanding this pattern can provide invaluable insight into market sentiment, offering a glimpse into the collective mindset of investors. By recognizing these patterns, investors can make more informed decisions about when to enter or exit trades, aligning their strategies with the prevailing market trends. The downside Tasuki Gap is recognized as a continuation pattern within a downtrend in the financial markets. To understand this pattern, it is crucial to visualize it as comprising three essential candles on a chart, marking a specific sequence in price movement that offers insights into market sentiment and potential future trends. The pattern begins with a long bearish candle, which signals a strong move downward, reflecting the prevailing bearish sentiment. Following this, a gap occurs, meaning the next candle opens lower than the previous one's close, further reinforcing the bearish outlook. The third element, however, introduces a short bullish or a less bearish candle that opens within the gap but does not close it. This particular setup indicates that while there might be some buying interest or decrease in selling pressure, the bearish trend remains dominant as the buyers fail to reverse the gap. The nature of this pattern as a beacon of bearish continuation suggests that despite a slight interruption in selling pressure, the market sentiment has not shifted significantly enough to reverse the trend. Instead, it highlights a brief pause before the downward trend is likely to continue. Understanding the downside Tasuki Gap allows investors to anticipate potential market movements and make informed decisions based on the observed patterns. However, it is also advised to consider this pattern in conjunction with other indicators and market analysis techniques to enhance the accuracy of predictions and investment strategies. Confirming the signal of a downside Tasuki Gap, a pattern observed in the downtrend of financial markets, involves specific steps. First, understand that a downside Tasuki Gap is characterized by a continuation pattern indicating further declines. This pattern emerges over 3 days during a downtrend. On the first day, there is a large black candlestick that continues the downtrend. The following day opens lower than the previous day's close, creating a gap. On the third day, the market opens within the body of the second day's candlestick, but closes in the gap between the first 2 days without filling it completely. To confirm this signal, an investor should look for a decrease in the price on the third day that does not close the gap created between the first and second days. This pattern is significant because it suggests that the selling pressure remains strong and the downtrend is likely to continue. Apart from observing these candlestick patterns, traders may also consider other indicators such as trading volumes or supplementary technical analysis tools to reinforce the signal's validity. For example, an increase in trading volume on the days of the pattern formation may confirm the strength of the downtrend continuation. In summary, confirming a downside Tasuki gap involves recognizing a specific 3-day candlestick pattern during a downtrend and may be supported by additional indicators like trading volume. This analysis helps traders and investors anticipate future market movements and make informed trading decisions. The downside Tasuki gap is a continuation pattern found in a downtrend scenario on trading charts. It signifies the potential continuation of the current downtrend. Understanding the reliability of this signal is crucial for traders aiming to make informed decisions. The pattern forms through 3 key candles. First, a long bearish candle signals strong selling pressure. This is followed by a gap down, indicating continued selling momentum. The third candle partially fills the gap created between the first 2 candles, but does not completely close it, consolidating the bear's hold on the market. Regarding the reliability of the downside Tasuki gap signal, it is important to consider it in the context of the overall market conditions and volume. The strength of the downtrend preceding the formation adds to the pattern's reliability. High trading volume on the days of the gap down and the partial fill candle can further confirm the bear's dominance. However, traders should use this pattern alongside other technical analysis tools and indicators to gauge the market's sentiment accurately and make well-rounded trading decisions. Combining this pattern with additional technical analysis methods enhances the understanding of market trends and improves the predictability of future price movements, allowing traders to strategize accordingly. The downside Tasuki gap is recognized as a continuation pattern that occurs during a downtrend in the market. This pattern emerges when there is a gap down between 2 candles in a downward trend, succeeded by a third candle that opens within the body of the second candle but does not close the gap. It indicates that bears continue to have control over the market, suggesting the downtrend may persist. When integrating the downside Tasuki gap pattern with other technical analysis tools, the synergy can provide a more comprehensive view of the market. For example, combining this pattern with moving averages can help confirm the strength of the ongoing downtrend. If the pattern occurs below a significant moving average, it reinforces the bearish outlook. Similarly, using volume analysis can offer additional insights. An increase in trading volume on the days the downside Tasuki gap pattern forms adds credibility to the continuation of the downward trend. Also, incorporating support and resistance levels can assist in understanding potential reversal points. If the pattern forms near a strong support level but fails to break below it, it might signal a weakening downtrend. Overall, by synergizing the downside Tasuki gap with other technical analysis tools, traders can obtain a more nuanced understanding of market conditions. This comprehensive approach allows for better informed investment decisions and strategy development to navigate the complexities of the financial markets effectively. Navigating the pitfalls associated with the downside Tasuki gap, a continuation pattern observed in a downtrend, involves developing an understanding of its characteristics and implications in the financial markets. This pattern typically emerges when there is a gap between 2 candles in a downward trend, followed by a candle that attempts to fill the gap but does not fully succeed. Recognizing this pattern is essential for investors and traders who aim to make informed decisions based on the potential continuation of a downtrend. One key to effectively navigating these pitfalls is maintaining diligence and a critical eye on market signals. Given that the downside Tasuki Gap suggests a continuation of a downtrend, it might prompt investors to consider strategies that correspond with a bearish outlook. This could include increasing the portfolio's cash position, exploring short selling opportunities, or hedging against further market dips. However, it is important to approach this pattern with caution. Financial markets are inherently uncertain, and reliance on a single pattern without considering broader market context or other technical indicators may lead to misinterpretation of market directions. Therefore, investors should assess the downside Tasuki Gap alongside other technical analyses and market indicators to validate their investment strategies. Incorporating aspects like volume analysis, trend lines, and support and resistance levels can provide a more comprehensive view of the market and help mitigate potential risks associated with relying solely on the identification of continuation patterns like the downside Tasuki Gap. Engaging in continuous education and staying updated with market trends and analysis techniques will also enhance investors' ability to adeptly navigate the pitfalls associated with such patterns. By combining a disciplined approach to technical analysis with a nuanced understanding of market dynamics, investors can better position themselves to respond proactively to the opportunities and challenges posed by continuation patterns in financial markets. The downside Tasuki Gap is a pattern observed in the world of technical analysis, specifically during a downtrend in the market. It signifies a potential continuation of the downtrend after a brief respite. To identify this pattern, one looks for 3 key candles on a chart. The first 2 candles continue the downtrend, with the second gapping down from the first, signaling strong bearish sentiment. The third candle then opens within the body of the second candle, but does not close the gap, typically closing in the upper half of the second candle's body. This setup suggests that although there was a slight bullish response, it was not enough to reverse the trend. When considering strategic applications of this pattern, it's crucial to focus on its significance as a continuation signal. Traders might use this pattern as an indicator to maintain or enter short positions, anticipating the continuation of the downtrend. One could place stop-loss orders just above the gap or the high of the third candle to manage risk. It's also advantageous to look for confirming signals, such as high trading volume on the gap down or on the formation of the Tasuki candle, as these can indicate the strength of bearish sentiment. The downside Tasuki Gap, therefore, serves as a useful tool for traders who specialize in trend-following strategies, providing clear signals for reinforcing or initiating positions in the direction of the prevailing downtrend. Exploring variations of the downside Tasuki Gap pattern involves understanding how small changes can influence its interpretation as a continuation pattern in a downtrend. In its classical form, the downside Tasuki Gap is characterized by a gap between 2 consecutive black or red candles in a downward price movement, followed by a white or green candle that opens within the body of the second black or red candle but does not close the gap. This indicates that while buyers are attempting to push the price up, the selling pressure remains dominant, suggesting the continuation of the downtrend. Variations may arise from the size and shape of the candles, the exact positioning of the gap, and the volume accompanying these candles. For instance, a smaller white or green candle may suggest weaker buying interest, reinforcing the bearish outlook. Conversely, a large white or green candle that partially fills the gap might indicate stronger than expected buying pressure, which could warrant caution among bearish traders. Another variation to consider is the volume during these patterns. An increase in volume on the bearish candles and a decrease on the bullish candle could further confirm the bearish sentiment. However, if volume increases on the bullish candle, it may suggest growing interest from buyers, potentially challenging the downtrend continuation signaled by the pattern. Understanding these variations requires closely observing candlestick formations, the context of the overall market trend, and other technical indicators to make informed predictions about future market movements. Through careful analysis, traders can better gauge the strength of the prevailing trend and adjust their strategies accordingly.